I want to get back, though, to the chart that Mark was showing to you, Peter, where banks are on the bottom, and it's understandable if we start to see more normalization and rates rising that you might like that. But you're also talking about a different reason to buy into these deep value sectors, and you mentioned oil and gas as one of those. It's already the best performer year to date on the Stock 600. If you look at the breakdown of industry groups on the GRR screen that Mark showed you, I've got it up here as well. Does that mean that you don't want to take your profits out of this sector? Do you still see room to run for oil and gas as well?
We do, particularly in Europe, actually, and there's various reasons for that. We're still reasonably positive about the oil price, and of course the oil sector is still in backwardation, so there's positive role and carry for oil as an investment. But the oil stocks also look pretty attractive, even without oil prices rising that much, partly because they're going into a phase where they need to invest much less after a decade or so of extremely strong investment, where you were seeing significant rises in cost inflation. A lot of those pressures are beginning to recede, and that's again generating more cash flow and more prospects for dividend growth. And when we look at the valuation of these sectors and the high dividend yield, we think that's a pretty attractive place to be, particularly in the oil majors in Europe.
I'm just looking at the MSCI Emerging Market Index, Peter. We're racing around, but you're here. We're so happy to have you. Let's talk EM. Back in January, highest level since 2007. Since then, I'll tell you the exact percentage decline, but clearly we've come off those highs, those decade highs. Yeah. This EM jitteriness we're seeing across all sorts of countries, is there something of wider concern here, or are these idiosyncratic stories?
Well, I think the broader issue is that the very strong returns we were seeing in EM last year and the beginning of this year really reflected what was very much a Goldilocks environment. You were seeing this very powerful acceleration in synchronized global growth last year. You were seeing record loose US financial conditions, a very weak dollar. You were seeing this fiscal boost coming through in the US, which was raising the forward prospects for growth, and interest rates were very stable. Very attractive environment for EM assets. As we've moved through this year, global growth expectations have moderated somewhat. We've seen a rollover in the momentum of growth. The dollar has picked up, and US rates expectations have increased. And then you've had some specific issues, of course, in particular EM countries. Our view is that it's harder to look at it as a sort of defined homogenous asset class, but generally we think the sell-off is providing an opportunity for EM assets. Many of them look attractive from both credit and equity. They don't have the big external imbalances that they had back in 2015, and we think the dollar's rise will be limited and global growth will continue. A pretty good environment for EM in general.